Global Impact Investing Network released its latest insights very recently. The report revealed that investors are showing increasing diversification, strong growth and viability of their impact approaches, which are all signs of a maturing market and proof that money is being invested where it can help solve the social and environmental challenges we face. The GIIN gathered insights and data from 308 impact investing organisations across 10 geographic regions, which have around about $370 billion of impact assets under management. The majority of the organisations are investment managers, but they also included banks, pension funds, foundations, and insurance companies, among others. As you might expect, the GIIN survey is flattering to the impact industry. It's accentuating the positive. It's growing, it's affecting more areas, returns are getting better, and so forth. So we're going to use the GIIN's report to help illuminate the impact investing story. But what I really want to hear about is what is actually happening on the ground. And to provide that narrative, we have Susanna Nicklin. Susanna is the non-executive chair of the Schroders BSC Social Impact Trust. Susanna, a very warm welcome.
Thank you. It's great to be here and I appreciate being invited.
No problem at all. It's great to have you. And we were just chatting, you're in training for a marathon at the moment.
I am. I am running Amsterdam in October, and so I'm sort of ramping up the mileage at the moment. So it's really nice to be sitting in this comfortable chair.
Rest up those legs.
Exactly. I might be having quite a lot of water as well as we talk. So.
Always important to rehydrate.
Exactly.
Okay, so in the first part of the show, we're going to go back to basics because there will be probably quite a few people listening or watching that don't know too much about impact investing. So we've heard of terms like social responsible investing, ESG, which is environmental, social and governance. We've got ethical investing. We've got philanthropy as well, among many others. So let's start with, what do we mean by impact investing?
Yes, so it's an important question, and one that's worth clarifying because it does get a bit jargon-based, this whole discussion. So impact investing was a term coined, I think, around the late 2000, 2007, 2008. It became a sort of a term that's begun to be used in the financial markets as what we now call impact investing was beginning to become a part of the capital spectrum for from philanthropy up to risk-adjusted return investing, sort of traditional investing 1.0. And impact investing now has sort of had a definition which I think globally has been used. It was originally given to it by the GIN, the Global Impact Investing Network, which involves three key points. One is intentionality, one is measurability, and one is positive impact. So it's investment that is intended to create a positive, measurable impact with a financial return. And when you start deconstructing that, it's quite a beautifully elegant description of what it is. And we can go into all three parts of that, if you'd like, the intentionality, why that's important, and a cornerstone of it, the measurability of it, the positive impact of it, and of course, a financial return is quite an open-ended term as well. So it's that's the sort of collectively agreed definition. And hopefully listeners will be able to sort of see how that is different from other types of investing and capital use.
Yeah, so that's where I was going to go next.
Yeah.
We're saying there's so many terms. So let's start with probably ethical investing is probably what people are thinking when they think impact investing. But what's the difference between the two?
So I think it's useful to think of a spectrum, maybe one way to think of it, of investing. And if you think about philanthropy, maybe at this end, if you're looking at me, being the way of using capital that requires no return of capital. It's a gift. And the intention of that is to achieve some goal, some positive outcome, some mission that you want to see accomplished with that philanthropic donation, right through to what most people will think of as traditional investing, which is making an assessment of risk in exchange for some financial return, without particular intentionality around any other objective. And in between those two, there has been a spectrum of of types of investing that over the last, say, 10 or 15 years, there's been a lot of debate around and people have tried to define. And as you say, ethical investing is one of those. And on that spectrum, ethical investing is probably the one that has been around the longest in terms of a sort of mainstream asset allocation. It initially was an approach taken by foundations, endowments, churches, for instance, investors or capital owners, asset allocators who wanted to screen out types of investments that didn't align with their values. So it's very much values-based investing that has an ethical set of restrictions on what would be included in the investment.
So you might not want to invest in a company that makes guns, for instance.
Exactly. So, for instance, typically the type of industries that would be screened out of an ethical investment strategy would be gambling or guns or pornography or, even some will have different kinds of agricultural product like tobacco or other things like that. So it can be a range of ethical screens that can be applied. And that's also been known as socially responsible investing, SRI, over the years. So ethical and socially responsible investing have been around for several decades and were sort of the precursors in terms of intentionality around other aspects that have screened, but it's very much a negative screen. So it's just keeping things out rather than a deliberate allocation of capital towards achieving an outcome. That's sort of been the difference, which has emerged over the last decade.
Okay, so if philanthropy is on the far left, let's say, is SRI slightly to the left of that centre?
Yes. Yeah. Well, I would say it's closer to traditional investing. Okay. So you might say, so you have philanthropy, then you might have at that stage next would probably come impact investing. Okay. And impact investing is a very big umbrella term. And within impact investing, and I hope we'll today go into a lot of this because it's really interesting and incredibly important. And there's a really, I think, an explosion in not only interest, but also capability in it across the globe. Impact investing, and then you'd probably come to what you referred to as ESG, or some people call it sustainable or responsible investing. And those three things are sort of are terms that people have chosen to use in different ways. But effectively, there's also a spectrum within that of using environmental social governance criteria or factors to identify risks, to manage those risks, be they climate change induced risks, be they regulatory risks, be it governance, social agendas such as greater diversity on boards or in staff, etc. There can be a very wide range within the ESG factor list, but that is also becoming a much more standardized through regulations over time. But ESG investing and responsible investing has taken ethical investing sort of to a one step further, typically having some kind of view on a investment integration of these factors. So rather than just screening out things, it will, some strategies, some ESG or responsible investing strategies will actually be built around the intelligent research-based analysis of the value or the risk to value of E, S, and G factors. Yep. So if you're looking at the spectrum, I guess loosely I would say philanthropy, impact investing, with a range of impact investing in there, to responsible and sustainable investing, to ESG integration, which is more of a risk control often, and more traditional investing, ethical investing, and then more traditional investing that didn't take these other factors into account. I would overlay that this is these are terms. This is a market that is evolving all the time, and even I would say in the last 2 or 3 years, some people have argued, and I think there's some merit to this, that ESG investing is just becoming investing. That actually these are factors that any good investor would integrate into their analysis of whatever the assets they're looking at are. So I think for a while it was a new and different approach. Now it has taken on a much more of a, I think, mainstreamed understanding, and actually there's been a bit of a backlash in certain markets, which we can also come on to if you'd like, over the last year or two, with a view that how people assess the risks and how it's integrated may not always be the same.
Okay. So if I'm a traditional investor, I could use ESG to help guide the type of investments that I'm putting my money into. If I'm an impact investor, can I also be philanthropic, or are they two separate things?
Yeah, so philanthropy considered alongside all of this, and impact investing isn't really a replacement for philanthropy. Impact investing is a complement. It's if you think about the scale of the issues that the capital markets could be harnessed to, you don't want to limit the solutions to being funded only by philanthropy. It's not going to, or government funding. It's just not going to get there. I think, for instance, there's the strategic development goals, for instance, that the UN has set. I think there's an estimate of $4 trillion annually required if those strategic development goals are to be met. And so philanthropy on its own is not going to be enough. And even government purses can't reach that far. So really the harnessing of the private capital markets is really essential. And philanthropy plays a role often in proving models, in helping markets get built so that more commercial capital can find its way there. And so sometimes there's for periods of time or permanently, there can be a sort of coexistence. And you see that, even in an example here in the UK are some of the social banks that we have, like Charity Bank or Schroders. And their raison d'etre is to provide loans and capital to charities and social enterprises in the UK, alongside being a functioning, commercially viable high street bank. And these banks take deposits just like every other. And so, that's a form of impact capital that actually funds and supports in a more sustainable way the operations of social enterprises and charities.
One of the, we'll go more into how it's actually working on the ground in the next section, but one of the 3 prongs of impact investing you mentioned was measurability.
Yeah.
And one of the GIN's findings was that identifying appropriate metrics to measure impact has historically been a challenge. So how can we measure the impact of impact investments?
Yeah, another huge topic, great question. And for listeners, it can sometimes become, I think, a bit confusing and opaque. And I like to think of it, first of all, just step back and think, what is the investment manager, or what is the investor trying to achieve, or what is the enterprise trying to achieve? What is the outcome that they're designed to accomplish? What is their mission? And how are they doing that? And then what evidence are they giving you that mission's being accomplished? I mean, it is sort of that simple and also that complicated. The industry, the impact investment industry over the last 15 years has really evolved and is much better placed now to provide standardized impact measurement. And it's called in the industry Impact Measurement and Management, IMM. And there have been a number of forums and really global collaborative partnerships to create commonality of management and measurement. And most good managers, so the listeners hopefully who might be interested in making impact investments or looking for managers, will be able to find really good impact reports that are published by managers, often using frameworks that are globally vetted and recognized. So the Impact Management Project, for instance, IMP, created a way of looking at impact and measuring and managing impact based on sort of 5 key points, which are what, who, how much, and risk. And so a lot of frameworks will hang on that, and then looking at a sort of rating of the depth of your impact of A, B, and C. So it's kind of across, it's sort of a nice way of thinking about where you as a manager are going to fit in terms of your contributions, your impact, what you're trying to achieve, what the risks are, etc. And then on top of that, bodies like GIN, Global Impact Investing Network, and others have also created really excellent mapping of impact criteria, of ratings, of ways of beginning to define the metrics you might look at if you are, say, for instance, in a given industry, like if you're a tech company or you're a regenerative agriculture company or you're a social housing lender, you're going to have really different impacts you're trying to achieve. And so there's been a big exercise that has really driven professionalism and standardization into the industry that allows investment managers to begin to compare investments, begin to compare their own performance over time, and to analyze and manage that impact, both at the enterprise level and at the fund level or the investor level. So I would say that managing it, so, I think you want to keep a sort of a no-nonsense view of it. You're still trying to achieve impact. Much of it still should be able to be communicated quite clearly. The industry is in the process of developing standards that will make this data comparability much better. And I think that in itself will continue to create a platform for more capital to come into it, because people will be more comfortable that there's an evidence base for that impact.
I suppose it's difficult because there'll be companies you're investing in that are on the different ends of the risk spectrum, and maybe some of those riskier companies won't necessarily have all the data that you need to make a massively informed decision.
Yeah.
So it's about how do you know that the money you're putting in, you're getting the impact out of it that you've actually required? Yes,
that's a really good point, the risk return question. And within impact investing, there are different. You can position yourself in different ways on the impact return versus the financial return. And some investors will choose very actively to take high financial risk for less impact risk.
Okay.
So you might say, we know this intervention is very likely to deliver really high impact. Mm-hmm. Whether or not we make the financial return is maybe riskier. Mm-hmm. Conversely, there are going to be certain strategies where maybe the impact risk is higher. Mm-hmm. It's a less tested form of intervention or service that's being provided, whereas the financial structure of the vehicle or the investment is very safe, and so your financial risk is less. So I think the sophistication of the market is increasing, and investors are more capable now, I think, of positioning themselves in alignment with that balance of risk and return between financial and impact, risk and return, so that they can find investments that meet their needs. And that, I think, is really the key here, because there are very different objectives often in impact investors. And even in the GIN recent research that came out in June that you quoted, the spectrum of type of investors is huge. And you split, quite those investors that invest in emerging markets, developing markets versus developed markets is pretty much 50-50, very close to that. Even though I think about 74% of all impact investors are based in developed markets, where the money is going is pretty evenly split. But even within that, the investors that are seeking a market rate of return versus what might be called concessionary capital, where it's looking for a higher impact and maybe not such a higher market rate of return, there's a mix of that as well.
So two things: high impact, low return. That's more towards the philanthropic side of things.
Yes, that's right.
And also, you mentioned like a whole range of returns there as well. So it acts just like a normal market.
It is a normal market, and there's you can find a way to invest in impact across asset classes, across the capital structure. So it's a very it is an evolved market now, and geographically and in terms of asset classes, in terms of stage of investing, from venture right up through public equities. It's a very exciting time, and for anyone who wants to invest in impact, there really is a way to weave it into almost any portfolio. You may have to push your wealth manager a little bit, or if you're a wealth manager, you may have to push your investment committee a little bit, because it does take some educating. It's still a tiny fraction of the overall capital markets. I think the estimate of 380 billion globally is growing. There's estimates that it will grow in the next 5 years to over $1 trillion, but that's still only, compared to the ESG investing market, I think estimated at about 35 billion. So a trillion, 35, let's edit this, is 1.5 trillion, 35 trillion. So it's going to be a very small amount of the total market. But even within that, that's a huge amount of growth. The UK impact investing market has grown 10 times in the last 10 years. And the rate of growth is likely to continue, particularly as the standardization of data collection, of an understanding of the regulations evolves. So I think from an asset choice, from the choice of assets, any type of investor is going to have an increasing range that they can access. And depending on what their objectives are, what their point of view is, what their mandates are, they will be able to find a way to integrate impact if they want to into their portfolios. And you asked about return. It is, the recent, I think in the GIN report as well, they've done a study over the last 3 years of returns, and you do have a pretty wide range, just as you would in any group of investments. You have from the private equity pool of assets, which is the biggest part of current impact investing, I think a median of 15%, average of 25% annual return over the 3-year period, down to the fixed income low single digits, and public equities and real estate somewhere around 9 or 10%. So you are able to access a really wide range of returns. Of course, whether you're dialing up impact, whether you're dialing up risk, is up to you.
Which brings us absolutely perfectly along to the second section of the show, which is what do impact investments look like? Mm-hmm. Now, the GIN found that investors allocated capital across a range of sectors, as you just said. Energy actually is the sector that's creating the greatest interest. There's also got financial services and healthcare, water and education, etc. But I just want to start with the question: how do people choose what impact investment they want to make?
So the research seems to suggest that scale of the problem is the initial driving factor. So the bigger impact investors will sit back and actually, and this also is part of the impact management project map of managing and measuring impact. You sit back and you look at what are the issues that society needs to address. What are the big ones? Where is capital going to make a difference? And that seems, based on the research that I've read, to be the starting point for many. For others, it may be that they already have a mission. It may be a foundation or a family office or a separately managed account that has a particular social or environmental mandate, whether it's clean water or whether it's strictly just zero carbon emissions, or whether it might be homelessness or social welfare. So education, health, any of those things can have their own starting point for what you would look for. And so investors will choose based on what either their own pool of capital is designed to address, or they may sit back and think, well, where can we have an impact? Where can our capital make a difference based on the expertise we have, our location, our networks, whatever, will inform that. And then some investors will adjust their impact goals based on the investee's own objectives or business models. So, for instance, I think many impact investors will, once they've set the macro goals, will then work closely to define their impact targets in response to the work that their investees are doing. So it becomes a more enterprise-based impact-led discussion, and then that can set the targets, can set the units of measurement, KPIs, that kind of thing. And I guess that leads maybe to another point, which is there are often two kinds of impact that are discussed in this market. One is enterprise impact, and one is investor impact. And enterprise impact is central to why you as an investor would choose to invest in an enterprise or a charity or an organization. What is the impact you're anticipating they will have? What is the service? So is it improved mental health in the community that they're serving? Is it radically making the use of energy more efficient in that community? Is it eradicating financial exclusion in that community? Is it reducing domestic abuse? So that might be the enterprise impact. The investor impact has become probably better understood in recent years, because that is one of the defining features of impact investing, where the investor engages with the investee to elevate and deepen the impact they're having. The creative structuring of how capital is provided, different types of instruments, vehicles to create more tailored solutions for funding these types of work. That's an impact that an investor can have. And also the sort of up and down the ecosystem impact. An investor can have sometimes the ability to influence governmental regulations, can be part of the debate about policy, can be part of the debate about regulations, can be part of the influence of changing governance questions. There's an ecosystem role that investors can play that can make it more likely that these enterprises will be able to accomplish their impact. And so I think, and in fact, the management and measurement of impact that they're doing is part of that too. Is holding people to account and helping illustrate and illuminate what it is that these enterprises are doing.
Yeah, so proper active ownership.
Exactly.
Actually properly get involved.
Yeah.
So it actually does bring me on to my next question, which is, what do these impact investments look like in reality? So I guess quite a lot of people will think, if they're investing in the energy sector, it's going to invest in a wind farm somewhere. But if you want to invest in the financial services, what does an impact? Are you just going to invest in a local bank and saying, here's my money, can you put it into, I don't know, trying to help reduce financial inclusion?
Yes.
Is that the sort of thing you do?
Absolutely. Yeah. So there's a huge range of types of impact investments at the grassroots level. So I'll give you a few examples. Really close to home here, we're recording in London. The West London Zone is a social enterprise that works with the most disadvantaged students in West London and measures their attainment in maths and English and their mental well-being, and conducts different interventions to support that group, that population, and then looks at how they're doing and adjusts and innovates and provides services and support, and has really had measurable, dramatic changes have been seen among the population that they've served. And if you take a control group or you look at other populations, it really has made a difference to a significant number of young people's lives. And that's, if you want to quantify the financial benefits of that sort of impact, you can begin to start doing that as well. So, for instance, recently Leeds and Cornwall did a really interesting study looking at the financial case, if you will, the business case for preventing homelessness. Mm-hmm. So homelessness is a growing problem, particularly in some of these rural areas where there just aren't enough homes. And how how you structure funding for that can be informed if you understand the case for allocating money to prevent it. Yeah. So if you fund an organization, a social enterprise, or a charity that actually gets in and works with people before they're homeless, how do we keep this person in a home? How do we make sure they're not going to be evicted? How do you stop the domestic violence before it gets to be crisis? Those are the interventions that over time make massive savings for government, therefore taxpayers, all of us, and also can generate savings at the local council level. So it's there are a lot of I think that's an example of an impact investing, right through to, as you said, in terms of financial services. The example I gave before, anyone can choose to put their money with a social bank as a very easy way to make an impact investment. You can also use CITR, which is Community Investment Tax Relief, which encourages you to make a loan or deposit into a community development finance institution, and you get 25% off of your income tax over 5 years, 5% each year. So there are some really good enabling ways you can do that. Some financial, impact investments might be microfinance if you're looking more globally. Mm-hmm. There's a huge and very well-developed industry of microfinance that has delivered excellent impact and very good returns as well in certain at least in certain markets and certain managers. But that's also an impact investment in a different level. Financial inclusion in terms of access to credit in a non gouging way has also been something that some impact led enterprises have looked at. Other types of impact investments can be something an organization people might know in the UK is Mind, which is a mental health charity. Mind, for instance, in Hull, the Hull Mind, has a really well-developed model of using impact investment to buy and restore homes that can help their clients get out of really difficult situations. So to support people with mental health issues for periods of time, to transition, to help families that are struggling with complex needs. And so they've created an impact investing model where by using loans and impact investment alongside donations, because for operating costs, these are expensive things and it's not easy to finance them. But with the benefit of impact investing in the form of loans, they're able to buy assets from which they can develop an income stream. And that can be a sustainable way to build and scale impact in a community. And it isn't hand to mouth every year having to raise those donations. So, I could go on and on because impact, the range of impact investing, of course, wind farms, like you said, community energy projects. There are so many exciting examples of communities coming together with share issuances. So local people can invest in their local solar farm or build a turbine in their river. And none of this is easy. There's a lot of, there are a lot of hoops to go through, a lot of and many different levels of stakeholder engagement to do that. But what's so exciting about it is we're beginning to see capital used in much more creative ways that brings it back home, that isn't out there, isn't sort of for other people, but is also benefiting
you can feel the
society.
effects of it.
You really can. Yeah, you really can.
And just one final question before we move on to the final part of the show. How do people find these impact investors? Do they have to find specialist wealth managers, or can they go into the local bank and?
Yeah, you can find it many ways. It's if you want to build a portfolio of impact investing, of impact investments, it is helpful to talk to someone who knows about it. And there are really great, very dedicated wealth managers and advisors that are experts in impact investing and building portfolios. So that's one route. It's also very easy to do it in a small way on your own. You can simply open a bank account with one of the social banks, and the use of your deposits will be for really important social good in the UK. You can also go on to certain direct funding platforms. There are exchanges such as FX where you can access different offerings for these community energy projects or other, sustainable housing, that sort of thing. You can actually buy or invest in social bonds. There are publicly traded bonds through a variety of either wealth managers or other platforms that are out there that fund important social projects. And actually globally, that's a really interesting, hugely growing sector of the market, across the country, across the world. So in Spain recently, CaixaBank issued a 1 billion euro bond dedicated for helping social cohesion and for rebuilding communities post-COVID. In California, for instance, there's been a 500 million bond issued recently, specifically for homeless, targeting extreme homeless issues that there are there. And so you can as an investor find that kind of publicly traded instrument. And there are funds. You can actually look for good funds that are impact-focused funds or that have some sleeve or some element of impact. And the providers of research around these funds are beginning to do a really good job, or beginning to do a more sophisticated job of assessing what impact means at different funds. And actually, I should mention, there's a lot of regulatory changes going on, and that will certainly impact this. And I think the intention is it should make it easier for the person on the street to navigate this. The SDR, the Sustainable Disclosure Regime, that is expected to come from the FCA sometime in the next quarter or so, is intending to try to define what different labels mean. Whether it's going to be a sustainable focused fund that is about trying to achieve certain carbon emissions targets or certain sustainability targets, or if it's a sustainable improvers fund. This is one of the labels that is being discussed at the moment, where it's investing in stocks that have an objective that maybe are dirty carbon emitting stocks now, but have a pathway to improving, and that the active ownership there is going to facilitate that more rapidly or more effectively. And then the label for impact could be quite important as well, because it will allow investors to say, okay, this is different than sustainability. Impact is different from sustainability. Impact is actually about also the intentionality of the outcomes and choosing investments for that specific impact outcome. And that will help investors who want to use their capital to make an impact, to find the right investment for them.
Brilliant. Well, let's go on to the final part of the show, and it's about the trends. So, I mean, you work in the business. So what are the trends that we're seeing? Let's start with the growth areas. Where are you seeing the growth areas in impact investing?
One growth area that I would note is increasing public market impact investing. And there are debates within the industry whether you can do impact through public markets, but there are some really good public market impact investors. And I think it's, as an investor, it's being careful, it's being deliberate, and educating yourself to understand, well, is this public market investor actually an impact investor? And what does that mean? What are their processes? How do they evidence it? What methodology do they use? Do they have a track record of it? And how do I see that being reported and communicated? But I do think that will be a continually growth. And given the scale of the issues that are, that we're facing, just for, I think in the UK to meet the 2050 carbon commitments, there's an estimate of something like, 35 to 50 billion a year needing to be invested. And so even with that, it's hard to see how public markets can't play a role, even though it does need to be a slightly different role, and certainly won't have the potency of impact that primary capital, and what I mean primary capital is capital that's invested directly as opposed to secondary trading in securities. And the primary capital will continue to be hugely important, and there's a lot of money that's been raised in that area. But I do think increasing the public, we will see as a theme more public market impact funds, and it will be partly the responsibility of investors, of asset allocators, to hold them to account so that there isn't impact washing, which could happen and has happened. And so a bit of upping the game on both sides, I think will certainly benefit the market. I think another trend is actually is just increasing standardization of measurement, and that's a good thing. I think there's also potentially a trend to elevate the reporting of impact, that away from maybe what has been before just the measuring of it, to also managing it and improving the management of it as a contribution from the investor that we're seeing.
You also mentioned earlier, I was quite interested, I didn't bring it up at the time because I felt it fitted nicely into this section. So I think you said it was 50-50 between developed and developing markets in terms of where the money's going for. But I think that would surprise quite a lot of people, because I think when people think impact, they think, well, it's probably developing markets. Is that quite a recent trend that it's flipped, or has that always been the same?
I don't know what the history of that ratio is actually, but I think it is. I don't think it would be that recent, because the development finance institutions, the big pools of capital for development finance, at least for the last decade or so, have been very leading and pioneering in experimenting with impact investing in developing markets. And there's a lot of money that's been there, and it's often been a complement to grants, as well as and other loans and so on. But it's been, that pool of developing markets, impact investing, has been a consistently important part of the whole market since it's been conceived of in this way. I mean, development finance has been around for decades and decades, and wasn't necessarily called impact investing. And there was a shift, and there has been a shift probably to distinguishing between grants and impact investing. And in fact, there's been some good learning. Part of the increasing sophistication and efficacy of impact measurement has come from learnings from the development world as well as from the charity world as well, where evaluating the success of grant-making programs has been part of what they've done for years. And so there's been a trend. I guess there's an evolution of that. And actually that's maybe another theme, if you're interested in themes, that I would say is, I think when impact investing sort of was starting to be banned, finding its first feet, sandbox sort of era 10 to 15 years ago, I think many of the leaders that came from traditional finance, and so a lot of, say, bankers and traditional finance professionals who maybe wanted to give something back, which implies they'd taken something away, and I'm one of those. Maybe it's now a new way of thinking about it, which is actually there's a much sort of wider pool of people participating in impact investing, coming from all different starting points. People who are coming from the business side, from the grassroots social enterprise side, from charities, from philanthropy, from academia, from finance. But it's an exciting and very rich population of people who are putting their brains together, I think, to look at the questions in new ways and come up with more creative solutions. It isn't all black and white anymore. They're really, so often it doesn't about whether or not you just throw more money at something. It's about the design and the intentionality of how you build that financing arrangement to create the outcome that you want.
Okay, and that actually brings on a very final question. It's actually brilliant. So I did ask in the previous section, how do you find an impact investment? Yeah. But what's the work being done around matching investors with potential investors? Because I imagine there's quite a lot of people out there that would like to get involved that maybe don't exactly know where to look or aren't getting the right guidance. Is there much work being done around that?
Yeah, there is. It's been a challenge, I would say, for a while. In fact, I wrote a piece of research when I first started getting into the impact investment industry about 12 years ago or so, looking at the role of advice in this sector. And it has gotten a lot better. I think advisors, wealth managers, other types of advisors, and participants are articulating what it is and what the options are better. I think matching people, partly it's individuals beginning to think, hopefully listening to something like this, talking to friendly folks at Schroders and elsewhere to find out what's on offer, what's available. There are so many interesting structures now. Investment trusts. Investment trusts are a share you can buy and are great vehicles for private market assets. And still the bulk of impact investments are private market assets. So investment trusts are a good starting point, range of alternative asset classes in there, and that any investor can look at and get research and choose one that might work for their portfolio. Also talking and just talking with your advisor, your financial advisor about it, and pushing. I think a lot of it is coming down to really saying, well, are you really, do you really know what you're talking about? Can we look a little bit deeper? I've heard about impact investing. I know that there are different asset classes that are available to me. There must be a way for me to do this. Am I taking advantage of it? And being clear about, particularly where you want to come out on that and how much you can't really go that far wrong. There are really good managers of impact assets. And we're talking about social and environmental impact. And environmental impact, I think this is very widely understood, the stakes at play right now in terms of climate change and the really exciting kind of revolution in the energy transition. And alongside that is what we call the just transition, which is the impact of the energy transition on people. And so there's a social element to that too. And there's going to be a real need for people to understand, how do we also help people reskill? How do we think about job creation? How do we educate? How do we, change built infrastructure? All of these things that are going to be kind of downstream from the energy transition. So the environmental and the social really are very much part of the whole problem, and the solutions that are coming out of that will take impact investment to solve that. So I hope people will proactively start looking at how, not just from a place of wanting to do the right thing for society, but also recognizing that their capital can actively be engaged with so many different engines of growth. These are the engines of financial return within impact investing are manifold. We haven't touched on it, but you can get returns in impact investing through tapping into government expenditure that is pursuing a certain policy. You can tap into it through the drivers of growth, through innovation to solve these big problems of food supply, through efficiency gains. So there's so many ways that the impact investing returns can be made. And I think, to your point about matching the investor to the investment, it's partly, being curious and interested in exploring how social problems are being solved. And then once you pursue that line of thinking, you're going to find the investors who are supplying the capital for that. And then there are ways, as an individual or as a trustee of a charity or as a institutional investor, to direct your capital to those managers that are doing that.
Yeah, well, there's plenty of issues out there that need solving, and there's plenty of people that are looking to invest in those sorts of issues. So just reach out.
Exactly. Yes, exactly.
Susanna, it's been a pleasure speaking to you. Thanks for coming in.
It's absolute pleasure. Thank you so much. Really appreciate it.
And good luck in the marathon.
Thank you.